Take back control of your money by learning how to be the bank. I say this all the time, but what do I really mean? Well, what I'm talking about is a concept called the infinite banking concept, created by the late R. Nelson Nash in his book, Becoming Your Own Banker. But today, what I want to do is I want to talk about the infinite banking concept, but I want to eliminate one thing that everybody thinks of when they think of infinite banking. What do you think of? Whole life. You think of a whole life insurance product. And you might even say, yeah, but Chris, it's specially designed and engineered. And I would say, right, exactly. But what if we talk about the infinite banking concepts without the whole life? Does it still work? People think about this all the time. Well, yes, actually it works just fine. So the infinite banking concept, make no two ways about it. It's a process. It's a process of you taking back the banking functions in your life, because someone has to be in control of the banking functions in your life. And who that is really up to you. You can have the bank, the traditional bank, be in charge of your banking functions. In other words, you can take the money you earn and you can take that money and you can give up control of that and give it to the bank. And some of you are like, no, I'm not giving up control. Wait a second. Yes, you are. Because when you put money in the bank, let me just ask you, what does a bank do with that money? Do they put it in the vault with your name on it, like a little box with your name on it? No. The bank takes your money and they lend it out to someone else. Now, when they lend it out to somebody else, do they make a higher interest rate on that loan they made than what they pay you? So if they pay you 4, do you think they're charging that person for that loan less than 4? Absolutely not. They're probably charging 6 and they're making a spread. But whose money was it to begin with? Well, if we go back to the original source, it was your money. And what did you do to earn that money? You traded your hours, your time. How much is your time worth? See, some people are like, well, I get paid $20 an hour, so I guess I'm worth $20 an hour. That's the wrong mental attitude. Your time is priceless because you can't get any back. But you do have to exchange time for money. That's just the way the system works, right? So we get paid a certain amount for each hour, and then we take and we exchange that for this money. And then we take and we put the money in the bank or some other source. And then from there, we determine what happens. But the infinite banking concept is just changing where the money goes first, which normally we say put it in a specially designed whole life. But let's eliminate the whole life. Let's just keep it in the bank account. And let's say you're a really smart consumer and you have found a really good bank that actually pays you interest on the money that you put there, because there are some banks, like the bank that I bank at, that pays no interest on checking accounts. What's your bank paying? Okay, maybe you have to change it from a checking to a savings account and find a high interest savings account. So does the infinite banking concept work from a bank account? Well, I don't know. Let's just do the math. Now, all I want you to do right now is I want you to articulate what the infinite banking concept is. And I'm just gonna draw it right here on the screen. Over here is a box. You see that box? That is where your money starts. Now remember, in the infinite banking concept and everything we teach and Nelson Nash taught, that's a specially designed whole life. But eliminate the whole life and put in a high interest savings account. So now your money's in a high interest rate savings account. And what are we gonna do? Well, the infinite banking concept says take back the banking function in your life. So what banking functions are we giving away? Remember, I said banks take your money and they lend it out. Well, aren't you one of those people the bank lends money to? You are, right? Look at the car you're driving. Do you make monthly payments on that car? I bet you most of you do. And when you make monthly payments, who do you write the check out to? It's probably a bank or a finance company, but they are all banking institutions. So when you write that check to that institution, who are you giving that money to? And who are you giving up control of that money to? That financial institution, which means once you write the check to them, you can't take that money back. You can't use that money again. And you gave away the interest that they charged for every one of those payments, because every payment you make on a loan includes 2 things. Who can tell me what those are? Interest, yep, you got it, and principal. Interest and principal. Every loan payment, credit card payment, line of credit payment you make includes interest and principal. Taking back the banking function is when you make that payment, which is interest and principal, who is getting the interest? Who is controlling it? Well, If you give away the banking function, that financial institution is. So now, let's start with that circle again. Your money is sitting in a high yielding savings account, and we've got banking functions that we're giving away over here that we want to take back because we want to do the infinite banking concept without a whole life. So we take money from the savings and we take a withdrawal from that. Now, when you did that, if you took a withdrawal from your savings, does the bank still pay you that high yielding interest on the money that you took out? No. Okay, make a mental note. When you use a bank account, you are giving up uninterrupting compound interest because now you stop the flow of the interest. You're no longer compounding because you took the money out. But we're gonna take back the banking function. So we're gonna take the money from the bank and we're gonna pay off a loan. I don't care what loan. I don't care if it's a credit card loan. I don't care if it's a car loan. You paid off a loan that you used to make a payment to, and that payment included interest and principal. Following me? I know I'm beating this to death, but now you all understand. That's the top part of the circle. Money starts here. We moved it over here. We paid off a loan. Now, that payment you used to pay on that loan, we're still gonna make that payment, but we're gonna change the name on the check. And now, all you're gonna do is you're gonna write your name on the check. And where are you gonna deposit that check? Back in the bank account it came out of. Every month, the payment you used to give to their bank is now going back into your bank account, that high yielding savings account. So just draw the circle. Money starts on the left, comes over here to the right. That's the opportunity to take back the banking function. You take the money you were giving away, principal interest, you pay it back to yourself. And you do this systematically every single month. Just like you used to pay them, you pay you. This is how you take back the banking function in your life. And you just keep going round and round. Think of this like Monopoly. Okay, we all played Monopoly. Either you play it now, you played it when you were a kid, but do you remember the basic principles of the game? You started with some money, and then you went around the board, which was all real estate you could do. And you avoided jail, okay? So you can't do anything illegal here, so don't steal any banks, don't rob any cars, so we don't want to go to jail. But if you made it all the way around the board, even if you didn't buy any real estate, when you passed go, what did you get? You got money, right? So all we want to do is we want to play Monopoly in real life. We want to make our money go around the circle or around the board, and we want to pass go and collect our $200. So how do we collect our $200? Well, every time we go around the board, when it comes back to go, that is the check that you were giving away coming back to you. And the more times you go around the board, the wealthier you get. Perfect. You understand Monopoly. Now, Monopoly in real life, called the infinite banking concept, gets super fun. Now all of a sudden, you take the money from the savings that you started and you've recaptured and recycled all the money you were giving away. You took back the banking functions for all those debtors that you used to make payments, and now you make those payments back to yourself, which now means you have a lot more money going in that bank account. So now what are you gonna do? You're gonna look for some cool, fun investment opportunities. Just like Monopoly, we're gonna start buying some investments. And those investments are going to pay us income, sometimes passive income. So now we're going to start in the bank, okay, the high yield savings. We're going to move around the top part and we're going to invest that money. And we're going to get a return on our money, rent, investment gains, profits, whatever it is. But now we're going to take those rents, profits, investment gains, and we're going to move them around the bottom part of the circle, and they're going to land back in that high yield savings account. How are we doing now? Are you understanding the banking function? Because now we no longer need the bank because we've created a bank-like vehicle. And the bank-like vehicle is just a process, because banking is just a process. So, how many different vehicles can you think of where you could apply the infinite banking concept? I talked about a high yield savings, but could we get rid of the high yield savings and input your 401k for the company you work for? Sure you could. Because if you take a loan from your 401k, how much can you take? Well, the definition of that is $50,000 or 50%, whichever is greater. So now, yes, we can use a 401k, but there are some different things. When we take a loan from our 401k to go over here to the right side of opportunity to take back banking functions, like I just described, now that loan we took from the 401k must be repaid. Otherwise, there's tax consequences. So we take whatever it is we earn over here on the right and we move it back, but now it's going to go back into the 401k. So every single pay period, you have to pay back that 401k loan. But here's the cool part. Now, remember in the bank account, when we took money out of the account, we stopped the flow of interest. In the 401k, we also stop the flow of the interest earned on the investments, because to take a loan from the 401k, the money's got to be sitting in cash. So when we take the money out, we're not earning interest on it anymore. However, the 401k administrator is charging you interest. So you are being charged interest on the loan you took. But when you make the payments back to the 401k, which those payments include principal and interest, who keeps the interest? You do. A lot of people don't know this. The loan interest charged on a 401k loan is paid back to your account. So when you take a loan from your 401k, if they charge you 6% on that loan, that 6% is going back in your 401k. That's right. So now you got the added benefit. Now we're making money twice. You're making the interest that the 401k charges on the loan, and now you're also making whatever interest you were giving away or whatever the investment returns are. Both are coming back to your 401k. Let's go one more round. Get rid of the 401k and add a home equity line of credit. Now in this country, a lot of wealth sits in the rafters of your house. It's called equity, and we always brag about it, right? You're out to dinner with your neighbors and they're like, oh man, my house is appreciated so much. I got so much equity in it. Great. How is that helping you live a better life? It's not. So it's not helping you go on more vacations. It's not helping you pay off more debts. It's not helping you do anything. It's just, you're just bragging that you've got equity in your house. Well, yeah. All right, great. Well, let's apply the infinite banking concept and let's get that money moving and working and taking back the banking function. So now, home equity line of credit. Great. Now we got access to the buried, lost, lazy money sitting in your rafters. We're gonna take that money out. Now what happens when we take money out of a home equity line of credit? The bank that issued the home equity line charges you interest. Now, quick teaser. Now tell me, who does the interest get paid to? That's right. On a home equity line of credit, the interest charged by the bank, when you pay it back, it goes back to the bank. So you didn't get control of that money, because now when you paid the interest, it went to the bank. It didn't go back to your 401k like before, right? Right. But now we've got this money that was locked up, and we use that to pay down debts, to take back the banking function, to take back the investment returns. And we move that money back around the bottom part of the circle back to the home equity line of credit. How much money did you make? Well, you made the money on the right side by taking back the interest you were giving away. But what else did you make money on? Well, you made money on money that was buried in your rafters. So now effectively you actually did benefit, and you took back velocity of money as well. But you know what? All I'm trying to do here, folks, is show you that you can apply the infinite banking concepts to take back the banking functions in your life while not using a whole life. But why would you want to use a specially designed whole life? I think is the real question. So I just went through a high yield savings account. Okay, I just went through using a 401k for the infinite banking concept. And then last I used a home equity line of credit. I could have went on and on. I could have used brokerage accounts, any place money sits, I could have used them all. But why would Nelson Nash and why would all of us say that the ultimate place, the best machine for the infinite banking concept is this specially designed whole life policy? Yeah, mathematically, that is the best place. So let's just talk about why. You already understand the infinite banking concept, right? Simple, the circle we keep doing. Now, get rid of that home equity line of credit and input a specially designed whole life. So what does the specially designed whole life do? It pays you a guaranteed interest rate for the rest of your life that never changes. Great, so mark that one, box checked, guaranteed interest for the rest of life. Number two, if it's a mutually owned insurance company, you will get a dividend, which a dividend is a return of unused premiums or profits of the insurance company. So now when you get the dividend, that is also money that you get to keep. So interest and dividends. 2 boxes checked. The interest and dividends, if built properly and built within the IRS code, which is the Max 7 pay rule, we do that for you. You don't have to worry about it. What else can happen? Well, it can be tax advantaged. It can grow tax deferred. And it actually could be that the internal buildup of that interest and dividends grows tax free. So your bank account didn't do that. Oh, no, no, no. Your 401k, yes, that did grow tax deferred. But when you take the money out, it's tax free. So it's tax advantage, but only one of the 2 boxes are checked. And the HELOC, well, that's different, but you could say that the HELOC interest charged by the bank is a write-off, okay, fair enough. The whole life has tax advantages. Let's keep going down the line. When we take money from a whole life, how do we take it? Well, we take money from the whole life the same way we did the 401k, the same way we did the home equity line of credit. We take a loan from the whole life. And when we take a loan from the whole life, whose money are we using? Drum roll, please. That's right. You're using the insurance company's money, not your money. Your money in the cash value is still in there earning uninterrupted compounding interest. That's right. So your money now has the ability to grow while you get to use the money. But then some people will be like, wait, Chris, hold on. The insurance company charges you interest on that money. Yes, they do. Just like the 401k did, just like the HELOC did. Except the 401k, when you got charged interest and you paid the interest back, it went into your account. The insurance company is more like the HELOC. When you pay the interest on the loan, that goes to the insurance company, not to you. But one big difference, if all of you were paying attention, is that your money, the interest and dividends, which by today's standards is anywhere between 5 and 6%, is still being paid on all the money. So if you're making 5 to 6% and the insurance company is charging you 5, what are you making in between? A spread. But you see, the spread's really cool to talk about because this is the only vehicle of all the ones I mentioned that allows this to happen. This is the only vehicle where you can make a positive spread on your money that continually increases every single year and never has the ability to be disrupted because it's math. I know you were expecting some big because. No, it's just math. It's math. And the compounding nature of how the cash value grows and the tax advantage nature of how it grows allows your money to do double duty. And then we take that loan and we do everything over here on the right side of the circle, taking back the banking function in our life. But now when we pay the money back to the insurance company, when we deposit those recaptured and recycled dollars that we used to give away, principal and interest payments, that money's going back to the whole life, which is now doing what? Well, it is reducing the loan to the insurance company, which means the APR actually paid on that loan is less because you're paying simple interest on a lower balance every single month. What other one did that work on? Well, that would have been similar to the home equity line of credit, but the home equity line of credit didn't pay you interest on anything. You just got to use the money in your house. It paid interest on none of that money. The whole life pays you interest and dividends on all that money and allows you to use it. And when you pay it back, it reduces the balance, meaning your spread, by sheer nature of mathematics and the difference between compounding and simple interest, the math increases your spread. Every payment you make back, every month, every year, that you do this, and your money's still compounding. Oh, and I almost forgot one of the most important things that separates the specially designed whole life from all the others in the world is the day you die. The whole life, out of more so than any of the other ones, actually the only one of the bunch, pays a tax-free death benefit to your family when you die. So, are you starting to understand why the infinite banking concept works best with a specially designed whole life, but does not only work with a specially designed whole life? So as we come to the conclusion of this video, I do want to call out my shirt. I put this shirt on. It's a little tight nowadays. I've been hitting the gym a little bit, but it says collecting moments, not crap. I really hope that the last 15 to 20 minutes we spent together was collecting moments, was collecting useful information, not a bunch of crap. Take what you just learned and apply it. Apply it because it will change your life. It will allow you to build wealth through your own debts and expenses, and it will allow you to tap into the one most powerful thing in the financial universe called compounding interest. So hey, if you liked this video, now let's go one step further into this one called Max Cash Value. Let me show you how to really maximize the infinite banking concept using one of those specially designed whole lives. Thanks for joining me today. We'll see you on the next one.